Welcome to The Point. I'm Neil Stanley, and in this episode, we're going to talk about how bankers are looking at the economic conditions that we observe on an ongoing basis. So what we want to accomplish today is to pull up for you some of the things that we look at, and we want to provide as resources to you. So if you go to our website, thecorepoint.com, go to resources and go to analytics, click on analytics, you'll see key economic resources for bankers. And these suggestions for you to consider are really links to look at U.S. population, interest rates, size of debt, and other topics that we will cover fully here today to give you a sense of the spectrum of things that you're going to want to consider from an ALCO standpoint. So when we look at this, the first thing I want to bring up as someone who spent a lot of time in bank investments, ALCO, and actually working on a PhD that I did not finish many years ago in the 80s, is that economic activity is the allocation of scarce resources amongst unlimited wants and needs. And those wants and needs grow with the population. So as we see, even in the pandemic of 2020, we can see that we grew our population in the United States by over 1 million people. That means that we can expect that there will be continued economic growth, continued economic activity. Just a very basic concept. We look at the economic research available from the St. Louis Fed. We find that when we look at the 30-year Treasury, we can go out and look at information like that by just entering in what we're looking for here in the search, and we can come up with things that are important in terms of recognizing where we are in the economic cycle. What this system does is it shades the recessions, and so we can see this is shaded right now in the time frame we're in, and we can see the Great Recession back in 2008 and 2009. We can always use the little section down here to go change the time frame that we want to look at. So if we want to look at only the time frame from 2010 or even maybe 2007, we can go back into that time frame down here by adjusting this. So we can see, for example, the 30-year rates, where they were at in different time periods. What our data tells us based upon this, the most recent 30-year rate was a 234 back in March of 2021. So just helping you to understand how these tools are available to you and how you can use those. Here is the 30-year fixed rate mortgage average in the United States. And so we know that the mortgage boom that's occurred because of these low rates is certainly a function of some of the economic activity and interest rate opportunities. This is a site that I recommend to you. It is from the CIFMA. And it helps us to observe the size of the fixed income investment marketplace. So fixed income outstanding, you can adjust for the number of years that it has as increments, and you can see that we have a $51 trillion marketplace for bonds. And securities. You can see corporate bonds, mortgage backs. Here are the U.S. Treasuries, almost $21 trillion as of the end of the year 2021. And you can go drill into previous years. So here we can see that just a year earlier in 2019, it was 16.6. And so it went from 16.6 all the way up with all of the government activity to right at $21 trillion. This helps us understand the magnitude of these variables being altered and what it means to handle the fiscal and monetary policy issues when so many levers are being pushed and pulled. So I highly recommend this to you. Another site that you'll find in this is by the balance, and this is talking about where that national debt is held. They identify the categories, debt held by the public, and then debt held intergovernmental. So within the government, there are various balance sheets, and what they're suggesting here or identifying here is that 22% of the national debt is held by other sections of the government that have assets, and they've used those assets to purchase the U.S. debt. It also goes down here and shows us what the foreign debt levels are, and you can see that how that is increased over time if you hover over it. And currently, foreign and international debt or holdings of holdings of U.S. debt by foreign and international entities is about $7.2 trillion. A very significant, but maybe not as big as many of you might think that is. So I think it's very important to note that. And then when it comes to who are the foreign holders, you can look at Japan as the biggest at 1.2 trillion, China at 1 trillion, and then the entirety of the pie there. So I think that's meaningful for us as financial institutions to have handle on where some of that is. Many of you have probably seen this U.S. debt clock, and if you hover over certain sections, it will show you there what where that source is, where that's coming from. That $28.2 trillion of national debt is reflected on this. You can see the federal revenue that we're getting. You can see the U.S. population here that they're estimating currently, the U.S. workforce. A lot of statistics out here that one can recognize and possibly help us to understand sort of the dynamics of our fiscal and monetary policy activity. So just commend these to you as resources. And in this section, I'll end with this. We hear a lot about the Fed's balance sheet. The Fed, up until the Great Recession, really just had the securities on its books were pretty limited. But then it started buying assets, and so you see here now a number of categories of balance sheet components that didn't exist. The blue and the red really didn't exist before the Great Recession. And so these are different aspects of what the Fed is actively in the market for today. So I just commend this to help you understand a little bit about the dynamics there. Ultimately, recessions are about the gross domestic product. And going way back, as I pointed out earlier, you can open this up to get dates before the 50s, or you can pull it in so you see only more relevant data coming into the Great Recession. You can see the dip in GDP. A recession is 2 consecutive quarters of reduced economic activity. And then when we start to come out of the recession with growing the economic activity. Here we see the very distinct V that occurred with the pandemic, how our GDP dropped very aggressively, and then how it has come back in a very positive manner, and we are expecting that the recession will be ended here in fairly good time. And part of that is that we have ongoing reports of GDP estimates, and the system here from the New York Fed is called is a system that is called Nowcast, and the Nowcast is constantly updating what they think the quarterly GDP change is going to be. So they're looking presently at 6.86 for the first quarter is what is estimated to be the GDP activity. And then there's a different one by the Federal Reserve Bank of Atlanta. They have gone historically by the GDP now, and their latest estimate is 8.2. So they're looking at different variables and giving us a sense of how that GDP is going to change. So this is just the site that is the economic research site where we ask for dates of recessions, and you can see those are the shaded areas on those other charts. So what does that mean? We know that GDP is the amount of activity in the private sector, business sector, and net government activity. And so what we want to do is understand what it looks like from employment. So we've got here the employment rate, and we can see that we, of course, had a double-digit unemployment for a very short period of time back back in the Great Recession, and then it started to come down. In the pandemic, we had even higher recession, but unemployment, but then it came down much more swiftly. And we most recently in March reported a 6% unemployment after having reported a 14.8% unemployment in April of 2020. So we present this to you for just the understanding of context, but also having you have the ability to go in and manage this, access this and manage it yourself. You can see the websites that we're using, the fred.stlouisfed.org, and you can pull up a lot of different pieces of data, including the labor force participation rate. So even though unemployment may be changing, the labor force participation rate shows activity there as well. So a higher labor force participation with a lower unemployment rate is obviously very stimulating to our economy. Some other things that aren't maybe as directly thought of or historically thought of, but because of the pandemic, we're closely watching the death rate in the United States. And so you can go to the cdc.gov site and notice where we were last year with the level of excess death. This can be drawn down by state as well as looking at the entire U.S. And virtually every week from the end of March until just recently, for a year, we've had more death than normal. So if you've not been living under a rock, you know that because all the media channels are talking about this. And hopefully you are hearing and seeing and observing the declining level of death. And now I can tell you after looking at this for a year, I wouldn't necessarily say that these are final numbers, because what ends up happening is as new statistics come in, these most recent weeks will be revised, but it is definitely on the right track. And we're excited about that. So if you're thinking about how to help your board understand and your executive team understand where we're at in the pandemic, I think this is a very good metric. It's obviously kind of the ultimate metric of suffering would be the death rate. Now, there is still other suffering that's going on, as we well know, with hospitalization and just general health levels. The other thing I like to look at from an economic standpoint is the TSA, checkpoint travel numbers. And it wasn't long ago, April 13th, we hit the low for TSA activity. And you can see that last year, it came up a little bit by April 25th, but it's so far below where it was just a year earlier in 2019. So these metrics are really helpful to understand why we have had such a powerful variance, where we were booking about 2.5 million travelers through airports in the United States in 2019 per day. It went down to 100,000, and now we're back to about 1.5 million on certain days. So to me, it's a really good indicator of our societal activity and energy. So I met with Dr. Ed Siegfried recently, and he compiled this chart that I think is very, very helpful for us as financial institutions to understand where we are, where we've been, where we are, and where we might be headed. So what he did here is he put these three items together. GDP, which indicates when a recession is occurring, unemployment, which is a big factor in our governmental activity, and of course, Fed funds, which are set by the Federal Reserve. And what he pointed out, I think, so eloquently, was we entered a recession in the Great Recession, and what we found at that time, we had an unemployment rate of 5%. And the Fed funds were at 424, and we also had a GDP that was about to fall or was falling. That's why we went into the recession, and it continued to fall until it got to about right here. So that was June of 2009 when the recession ended. So the recession ended at a point when unemployment was all the way up to 9.5. So unemployment continued to go up even though the recession had ended. The GDP, the productive activity, was starting to go back up, but we still had unemployment. And the Fed fund rate was held at from 0 to 0.25. So as we went forward, we ended up getting out back to where the GDP had been around 2010. In other words, GDP had recovered from where it was at the beginning of the recession. It had recovered, but unemployment had not gotten back down. So we did not see any change in Fed funds. But when did we see the change in Fed funds? We go to December of 2015, and what we find is very interesting. The unemployment rate had returned back to the pre-pandemic, the pre-recession level of about 5%. So it's very interesting to note that although we may have GDP growing, it was considerably above where it was back before the recession or during the recession, but the unemployment had been higher until that date. That's, if you recall, when the Fed raised Fed funds for the first time. So if that applies today, what we may see with our Fed is an intent by them to hold interest rates low, not just until the GDP, which is currently at about $18.8 trillion dollars, when it gets back to the level it was before, about $19.2 trillion dollars, when it gets back up there, you may not see any change in Fed funds. In fact, we may be waiting until the unemployment rate, which most recently was at 6%, gets back to where it was when the recession caused by the pandemic occurred, and that unemployment rate was 3.5. Now, this isn't anything that is locked in as certain, but I think there is some validity to the theory that our officials are looking to get that unemployment rate back down to that similar level. So what Dr. Ed talked about, and I think he's right, is that we're going to see two recoveries. A recovery of GDP, which we think is going to occur fairly soon, but that won't signal monetary policy change as much as a recovery in unemployment, which is that second recovery, and we can then expect that the Fed will attempt to hold off interest rate changes until that occurs. So why do I say attempt? My belief is that these are all the intents of the Federal Reserve, but the Federal Reserve may not have a monopoly control of this, because not only are they a player in all of this, but the marketplace with all the bond buyers are also a player, and what they believe as bond buyers is going to have an impact. Those individuals and foreign entities that purchase our bonds may have an impact on what interest rates are in the longer term. So how do we bring this all into to conclusion to help us shape the thoughts about our investment portfolio or our funding portfolios? So I submit to you that I have been tracking the historical interest rates, and I use the 3-year Federal Home Loan Bank fixed rate advance as a metric to monitor. You can monitor different things in here. They tend to move together pretty consistently, but I've used the 3-year fixed rate advance. It's not a long dated instrument. It's not a terribly short dated instrument, to help us understand the level of interest rates. And so the blue line are the historical rates of the FHLB 3-year advance. And so we've seen over the last 21 years what rates have done. We start this on January 1st of 2000, and we go forward, and the most recent date that I have on this chart is April 13th. And what's interesting about it is that we're not just posting historical rates, we are posting the forward implied rates for the 3-year. In other words, what the market yield curve is saying rates would need to be if you could buy or borrow, short-term or long-term, it all works out the same. So This is a concept of total return and opportunity cost, where we're measuring what rates would have to do for us to be indifferent in terms of investing or borrowing, short term or long term. And what is powerful about this is that we can go back in time to the beginning of this millennium and see what the shape of the forward implied yield curve was. And we can look at what the actual rates did. So if you bought bonds on January 3rd of 2000, you pretty much were disappointed in your bond purchase because the rates went up much faster than the forward implied indicated they would. You were redeemed after a period of time, though, because rates, even though they went up, they went down. And you, out in here in 2002, could be very proud of the bonds you bought on January 3rd of 2000. But this is a concept where you're basically saying, what was the bet? Did we do better or worse than the bet that was based on the yield curve? And so we can go through this. We can look at other dates like May 17th. It was the best day in this decade, or in this century, to buy bonds. Whatever long bonds you bought on that day, rates have never recovered back to where they were in the 7.5% range there for a 3-year. And then we can go forward and we can see the steepness of the yield curve, which is basically the length of that line that it takes to go out 5 years into the future. How much would rates be expected to go up? And did they go up as expected? You only see that as you look back over time. A terrible day to buy bonds was June 13th of 2003, because even though there was a positively sloped yield curve, the rates went up much faster in reality than what they did in terms of the yield curve, what it was giving you for any investments you made. You didn't get paid enough. Even though you got paid more for longer terms, you didn't get paid enough. You would have been better to just stay in Fed funds and let that yield curve rise up until a later date. So a later date would have been June 28th of 2006, another ideal time to buy bonds as rates went down over that time period. So I won't spend time articulating every point on, but what you can see is as you go forward with falling rates and the steepness of the yield curve, you can see various places where it makes sense that you were getting paid, even though you thought rates were going to go up. It was fine because rates were not going to go up any faster than the yield curve predicted. And then there are these times like November of 2018 where, yeah, the yield curve is somewhat positively shaped. People thought rates might go up, but not very fast. And in fact, they plummeted. And so this was a great time to buy bonds as well. So different times here, you can see the slope of the yield curve. And you could have bought bonds on February 1st. The problem with buying bonds February 1st of this year is you got a lot better deal April 13th. So those bonds you bought on that day, that was just a couple months ago, they're going to be underwater compared to the bonds you could buy today. So hopefully this opportunity cost, what is the bet that you're getting, those are all helpful to you in analyzing your investment activity. I want to point you also to our website. If you hover over resources and go to articles and publications, you can find in here an article that we published. It was called Betting on Forward Implied Yields. And I just commend this to you today. It's really applicable at any time, but it was written back in the Great Recession before rates started to rise, and all about this topic that we've talked about today. So it's one thing in addition to this recording that you can share with your executive team and with your board to help them understand that even though you think rates might rise, if you're getting paid enough, you're getting some real economic value for making that investment, even though rates may rise and you may have some unrealized loss in that portfolio. The magnitude of that loss is dependent upon how fast rates rise relative to the forward implied yield curve. It's been a pleasure to bring this section to you today, this material. I hope that you have found it to be valuable. I also want you to feel very comfortable, if you have any questions about this, to use my link here, calendly.com link, to set up an appointment with me to talk about these topics. I hope also to be with you in a future episode of To the Point. Make it a great day.